Hello, friends. Good evening. Uh, Hope you and your loved ones are doing fine. Thank you for joining in for today's webinar on post policy update and fixed income outlook. We have been joined by our economist and a fund manager, Mr. Bhupesh Bameta, to share his perspective on this policy update and fixed income outlook. So, Bhupesh, today's policy announcements very much in line with, I guess, what markets was expecting or anticipating. I mean, broadly unanimous decision to continue with no change in policy rates. Uh, Accommodative stance to be continued. Obviously, there we did see a majority in 5-1 voting, though. On growth front, forecast retained at 9.5 for FY22, with governor also highlighting many uh, indicators or the high indicating indicators in a positive trend. On the inflation, I think the projected rate in terms of over the last policy is projected around at 5.7. uh, well, but still under the RBI tolerance band. And also Governor alluded, it's more of a transitory in nature. Uh, with all that background, Bhupesh, it would be great if you can share your perspective in terms of how do you look at this policy announcements, also in terms of broader fixed income outlook going forward. And it would be great if you can guide our partners, investors on what they should look forward in terms of their investments, also in terms of debt space going forward. With that, over to you, Bhupesh.
Thanks, Nan. Thanks for the introduction. So, as Nan already mentioned, uh, just to first give a brief outlook of what actually happened in the policy today. So, rates were unchanged, both repo, reverse repo. It was almost unanimous expectation from the market that rates will be unchanged, so no change over there. Guidance again remained accommodative, and there was absolutely no change in the wording of guidance this time versus the previous one. The only big change that happened this time was that the voting of the guidance was 5-1. So till now, since the beginning of the pandemic, all the voting that we've had was 6-0. They're the first dissent that we saw in the RBI MPC. I think market will take it a little bit with some, it will give this thing some importance. Besides that, the third thing which they announced was that VRRR, the variable rate reverse repo. There, the quantum of the VRR has been increased from 2 trillion rupees to 4 trillion rupees over a staggered way in the next 4 fortnights. Some part of the market was anticipating that this may come, but some were believing that this may come sometime in between policy, not exactly in the policy announcement. But RBI did it right now, and they went out of its way to explain to the market that this is not a withdrawal of policy accommodation, and this is just to ensure that so liquidity in the system has already been very much abundant in August. August first 4-5 days. We have seen a net, RBI net amount of money put in the RBI's overnight window at 8 trillion rupees plus. So a lot of liquidity is already in the system, and given the fact that RBI is already doing a lot of GSAPs, and in BOP also we are running surpluses, it was expected that this number can go up further going ahead. And therefore, some sort of this step was expected by the market. Now, despite this 2 lakh crore rupee of extra VRR, as RBI pointed out, by end of September, the amount of money which will be there in RBI's overnight window will still be 4 trillion plus. So, despite this, 4 lakh crore rupees of so-called withdrawal of liquidity from BRRR, the amount of liquidity which will be there in the overnight window will still be very much abundant. So it's not, I would say, in any sense you can say it's a tightening. It's just excess. Things have become too excess, and some part of it was anyway going to be done, and that's what they did. They also announced 2 GSAPs of 25,000 each. The first one is on 12th of August, and the second is on 26th of August. It's broadly in line with the expectation. It was in calendar, and that's what has happened. They also announced that beside GSAP, they will continue to do OMOs and operation interest. So in that sense, it remained quite accommodative. Now, so markets took the policy a little bit less dovish than they were anticipating, primarily because of these 2 factors: one, VRRR, and secondly because there was a jarring note in the guidance. Otherwise, I would say it's a pretty dovish policy. and especially dovish for the explanation which came in the post-policy press conference, where Dr. Michael Patra went out of its way to explain that why. So, okay, now the question which a lot of market participants had was that, you have an inflation target of 2 to 6% band and a 4% inflation target. Last year, we've had average inflation of 6.2%. This year, we are having inflation forecast of 5.7%. So, despite this high inflation, how can you be so comfortable in monetary policy, so dovish in monetary policy, and still say that you are maintaining this inflation targeting? So what Dr. Patra said was that he said that we shouldn't look into this as a 1.4% target. What actually happened was that because of pandemic, it was an exogenous shock, and it was not a pure demand supply thing. It was once in 100 years type of thing. And because of pandemic, we saw a big spike in inflation last year. So inflation then now, from after staying at around 4% for the last 4-5 years, since adopting this inflation targeting, because of pandemic, the inflation went to 6% plus. And now from pandemic, we are gradually, adopting this glide path of disinflation. If you remember, once, 4-5 years ago, when Dr. Rajan adopted this, when we had this beginning of this inflation targeting under Dr. Rajan, the key term that they used to use was a glide path of disinflation. So now Dr. Patra said that they are having once again this glide path of disinflation from 6% towards 4% level. And he was very categorical in saying that if we do it very bluntly, so he gives an analogy like, if you have a cold turkey and you kill it, you slam the turkey, then that's a big problem. So if you are they want to slam the economy like cold turkey, and the economy will get destroyed even if you have a disinflation. So what their approach is going to be is of a very gradual disinflation and a glide path of disinflation. That's what has been the keyword. So overall, we continue to believe that we have been those who have been attending these our calls would know that we have been saying that this withdrawal of this extraordinary accommodation is going to be a very gradual affair. This is not what a lot of people have experienced in post 2008 or earlier, when there was a sharp tightening of financial conditions when inflation blew out. This time, across the world, not only in India but globally, almost everywhere, the learning of central banks is that you can't tighten financial condition very fast. And the same thing is being done by the RBI also. So despite this high inflation number that we are seeing, 6.2% last year, 5.7% average this year, they will adopt a gradual approach to disinflation. And in that background, what we are saying is that in the near term, next I think 2 to 4 months, it is very unlikely that there will be a rise in reverse repo rate. And we believe that the operative rate will, given that the liquidity is going to remain very much surplus, the operative rate is still going to be the reverse repo at 3.35, and therefore the opportunity cost of staying in cash is quite high. Therefore, we tell investors, our recommendation for investors is that they should, those who have 1 to 3 month horizon, they should look to invest in ultra short term category. Those in 3 to 6 month horizon should look into low duration fund, and 6 to 9 month floater. Over that, you should start looking at short term corporate bond fund and our banking and PSU fund. And those who have a horizon of 3 year plus, we recommend them to come to our GSEC fund, where we have a roll down strategy, and also our income and credit risk fund. The key point again to point out, we have been doing this in our earlier calls also, is that the opportunity cost of staying in cash is very high. Yield curve is reasonably steep. It is already pricing in a lot of rate hikes. I just come to those part. The first, let's see what the projection is. So, okay, this is your inflation and growth projection. In June policy, they had forecasted a 5.1% inflation. In August policy, they are forecasting 5.7% inflation. That's a hawkish surprise for the market. While inflation number have been coming out a little bit higher, but people were thinking that it will be around 5.5% forecast. So it's a little bit on the higher side. However, in growth front, they remain pretty same at 9.5 versus 9.5. There was a shift in composition of the growth. So the first quarter growth number is likely to be higher than what they had forecasted, but going ahead, we are going to see a gradual recovery. So in terms of yield curve evolution, if you look since the last policy, we have seen a decent pickup in yield between 8-10% to 8-10 bips to 20 bip since the last policy. But still, if you note, the yield curve is still very steep till around 7-year point in GSEC. And if you look into the SGL curve, this curve is very steep till about 5-year point. So what we are saying is that given that this front end of the rates are likely to, because these rates remain very well anchored to the operative rate, and given that we believe that the operative rate will remain around 3.35 for next 3-4 months, therefore the opportunity cost of staying in cash, because the yield curve is very steep, is very high, and therefore, depending on an investment horizon, you should go up the yield curve to gain the accrual gains. Given that, number one, a lot of rate hikes are already in the price. The market is already factoring in a very steep rate hike cycle. 25 basis point in the next 3 months, 70 basis point next 6 months, and next 1 year it is already pricing in 143 basis point rate hike. So market is already factoring in. So this yield curve is already factoring in a very steep rate hike cycle, which we believe is a little bit unlikely. But even if this happens, so this number is already in the price. If you look into what RBI has been saying today, they are saying that it will be a gradual policy normalization. But even if it turns out to be this level of hawkish rate hike, a lot of it is already in the price. Therefore, and the very high probability that you will be surprised on the positive side in terms of actual outcome. And therefore, what we are saying is that given the steepness of the yield curve, it's better to, I mean, depending on the investment horizon, it is better to move up the yield curve to gain the accrual part, and to justify, I mean, to nullify the loss that you are getting, the opportunity cost that you are getting, that you are facing if you are stuck in cash. Just to give a macro backdrop, what we are seeing globally, one, in DMs, what we are seeing is very stellar growth numbers. If you look into economy of size of US and Europe, where we are typically used to 2%, 1% growth rates. Last 2 quarters, we have seen 6.5% odd growth rate. Next quarter, there is a lot of debate whether this number will be achieved or not. But what we are seeing is that at least in US, its data points are suggesting that we are near the peak of the growth cycle. Data is likely to gradually deteriorate from these levels, but still remain very much elevated. So I mean, 2-3% growth is still a very good number for US. And in Euro area, they came into this pandemic a little, the second wave a little bit later, and therefore their growth peak is likely to happen in the third quarter. Same with UK and Japan also. So what we are seeing is that growth numbers globally in DM economies remain very strong. But in US, we are beginning to see a peak of growth rates, and from there should be a gradual decline in rates. In Euro area and UK and all, I think growth will peak sometime next quarter, and then there will be a gradual decline. But despite our prognosis that there will be a gradual decline, our sense is that the growth will still remain much higher than what we are used to for the next at least 3-4 quarters. In terms of the most high frequency indicator that we have got, what we are seeing is a big divergence happening between the DM growth and the EM growth. So what has happened was that DM came out with a very big policy stimulus, a mother of all stimulus for economy like US. They came out with a 25% of GDP fiscal stimulus. Similar number, I mean, little bit lesser, but very high number, high double-digit numbers for other DMs also. So very big, very aggressive fiscal stimulus, plus high degree of vaccination, plus very aggressive monetary stimulus. All these three combined meant that there was a very sharp recovery in growth in DMs, and we are still seeing a very strong growth there. In EM, the fiscal space was less, and the monetary policy easing was also not that much compared to DMs. Plus, now we are seeing a big resurgence in virus over there. And all this combined means that DMs are racing ahead of EMs in terms of growth normalization. In India, I'll come to this part, but we are seeing a recovery in growth in the second wave already beginning, and gaining some strength. The recent PMI numbers for manufacturing have been a decent 55.3. Even in services, we are seeing a recovery. Now, the key point, I mean, the key debate which both the bond market and I would say also the equity markets and maybe probably even the commodity market is having is about this, talk about this US inflation and whether this inflation is transitory or it is a permanent thing. What we have seen in US is that over the last 2-3 months, I think since the beginning of this year, I would say, but especially in the last 2-3 months, we have seen a very big spike in inflation. Both their CPI headline inflation and the core inflation are like multi-year highs, some are at multi-decade high. But if you look, past more into the data, what we are seeing is that this high inflation is being led by only a very small component, small part of this overall CPI basket. So if you look this chart, it says that only 8% of the index overall basket is growing by 32%, but the rest 92% basket is growing by only 2%. So while we are seeing a very big spike in inflation in US, the numbers suggest that it's a very skewed distribution of inflation, and probably this is because of pandemic-related thing. If you're looking to break down things like airfares, hotels, used cars, so segments which are impacted by pandemic are the segment which are seeing this big spike. And in all broader segment, what we are seeing is a very muted 2% inflation, and that is giving a lot of confidence in the market, in the central bankers, and even in IMF, that despite the spike in inflation that we are seeing in US. And also in many other advanced economies, people believe that it's going to be a temporary spike, and once this pandemic-related stuff die down, we will see inflation going back towards normal levels. The result of this is that in the beginning of this year we had this big spike in US yield, but now as market is getting more confidence that this spike is inflation is likely to be transient, yields have started collapsing in US from around 1.7, 1.8% few months ago now to around 1.2%. And if you look into the US real rates, they are at the lowest level ever. So this is the big. So despite this very big recovery in growth, and despite this fear of inflation in some segment of the market, US rates are at very, very low levels compared to the state of recovery. And what market is believing is that also in US, like in India, the Fed rate hike cycle is going to be quite gradual, and most likely sometime in 2022 we are going to see the beginning of rate hike cycle. So what this does for India is that for an EM economy like India, you always have to be, you also have to keep in back of your mind what's happening in US. US is like the mother market, and Federal Reserve is, you can always have this paradigm that look into two central banks: one your own central bank, and what the Fed is doing. Second, what the Fed is doing. So Fed is like a pseudo central bank to the entire world because it's a reserve currency. And not only RBI is saying that they are going to be gradual in their approach, they are going to see through this inflation. This is transit inflation, and it's an inflation brought about because of pandemic. Somewhat similar tone is coming from the Fed also, that they will be okay with the spike in inflation. They expect this spike to be transient, and hence even for US, the likely course of rate action will be very, very gradual. So both these things we should keep in mind, and when we decide where to put money on. Yeah, that's one thing. Again, now the important part, COVID. So we are seeing a big third wave happening, as to say, in world economy. This is mostly driven in Asian EM economies, Indonesia, Malaysia, Thailand. These economies are seeing a big spike. We had some sort of spike also happened in UK earlier, and now it's happening somewhat in US and Europe also. But the key difference that we have seen versus the earlier spikes, and is that big part of the world economy has already got decent degree of vaccination. And just to see the impact of vaccination, so just look at the lower two chart, very interesting charts. It compares the how the pandemic has fared between a country like UK, where vaccination has been 60 to 70%, and Russia, where the vaccination has been a very low number. So if you look into this chart, while in this wave, in this second wave, so as to say, the number of cases have gone up significantly. If you look into the number of deaths and the number of hospitalization, they're at a very low level compared to earlier. So earlier, in the first, second wave, the number of deaths and the number of cases had a similar trend. But in this third wave, because of vaccination, while the cases spiked significantly, the number of hospitalization remained very low. Compare that to US, to Russia, where despite everything was similar, race of people, but still we had this big spike in cases in Russia and also a big spike in fatalities. The comparison of these two charts clearly suggests that vaccination has had a very big role in preventing hospitalization and deaths, which is the key thing which policymakers and people in general are looking at. In India also, we are seeing the second wave is just going down, except for few states like Kerala. The point to note is that vaccination is also pretty decent now at 40 lakh per day. Most likely in August and also in September, I think supply is going to be increased, and we should see a further pickup in the vaccination rate. In terms of India's economic activity indicators, so I just alluded to this earlier. PMI was also given the similar picture. So just compare the first wave of, this is actually Jeffrey's activity indicator chart. It suggests how is the overall level of economic activity in your economy compared to a pre-COVID level. So pre-COVID has been pointed at 100. So in the first wave that we saw, March 20, April, May, June, July, we saw a sharp fall in economic activity as we had this big lockdown. And then a gradual pickup in activity to reach the pre-COVID level sometime around Jan, Feb, March. So it's a very sharp dip in the economic activity and a very gradual uplift for the next 7-8 months. Compare that to the second wave, because we didn't have a big lockdown. We had this somewhat smaller dip compared to the first wave, and also very fast recovery. It's like a 3-4 month affair. This economic drag in this wave compared to the first wave, and now activity level is back to the pre-COVID levels, pre-second wave level. So we had a pretty decent recovery. However, monetary conditions have remained very loose. RBI has been honest. Despite this pickup in activity, one can argue that RBI is forecasting 9.5% growth for FY22. Many in the markets are in broadly similar level. We are somewhat higher level, but still our number is also around that range only. So what we are seeing is that if we, so why on optically 9.5% YOY appears to be a very big growth number, but I mean, we have to see it in the backdrop. The last year we had I mean, close to 7% negative growth. So if we just do a 2-year CAGR of growth, I mean, growth numbers are still like 2-3% over the pre-COVID levels. So despite this, despite the very good fact that economic activity has come back to pre-COVID levels, the growth of activity that is only around 1-2% on a 2-year basis from the if we compare from the pre-COVID level. So growth is still while the recovery is very good and we should take heart from it. I mean, it's still a very weak growth that we are seeing. And RBI has been in the forefront to ensure that rates remain very low. They have cut rates aggressively across the spectrum. They have done a lot of OMO, a lot of GSAP, doing everything in their hand to keep rates low. And that has resulted in the monetary conditions becoming, turning very loose. If you look into weighted average borrowing rates, weighted average lending rates, all of them have trended significantly lower. If you look into the real rate, which is rates adjusted for inflation, across the board we are seeing negative rates, which means that RBI, one can argue that it's a financial repression which they are doing, and they are ensuring that money moves out from the hand of savers to the hand of creditors and investors. So I would say it's a deliberate policy choice. We had this pandemic. Because of pandemic, there was a lot of disruption. A lot of people who would have taken credit wouldn't be in a position to repay the money, and they generally wanted to help economic growth. So like the same thing which happened in the most advanced economies. I just showed you the graph of US, and similar graphs are there in Europe also. Across the advanced economies, they have done the same thing of negative real rates to ensure that money moves from the hand of savers to those who are willing to invest money. And somewhat similar template is being used by RBI also. And one can argue that this is one reason why there is a change of yield that is happening across the board, and a lot of money is moving to equities, and maybe now possibly it can move to real estates and all. That is one thing, but that's a policy choice which RBI has taken. Other key indicator which we in bond markets are keenly focused on is inflation. This is the month-on-month numbers of inflation. You see deep red. The red, okay, the color code is such that red means very high number, green means a very good number, I mean benign numbers. So we had very high red numbers of inflation in 2020. Through the pandemic, we had very high inflation. And it started moderating once economy started reopening. But again, in the last 2 months, once we had this big strong second wave, we are again seeing a higher number. But the good point to note, this is the YOY number, this is the month-on-month number. The good point to note is that the momentum of inflation, that is the month-on-month number, has moderated in June. However, the number still remains quite high. And that will be okay, it's a two-way to look into it. One is that the number still is on the higher side of RBI's band of 2 to 6%. The second way to look into this is that the momentum is declining. So this number will be the key determinant of how early or late RBI goes on to normalize the extraordinary monetary policy, easy monetary policy that we have discussed. But okay, one can argue that why, despite inflation reaching 6% corridor and remaining so high, why are they so confident? So one is that the description which Dr. Patra gave, that they don't want to cull the economy to bring down to bring about disinflation. The second thing to note is that if you look into inflation composition, you look into the credit growth is still very, very anemic. Incremental credit growth is almost about zero YTD. You look into the CP outstanding, the numbers are still very low. You look into the corporate bond placement, the numbers are still very low. So it's very difficult to argue, and overall demand condition still remains muted. As we discussed that on a 2-year basis, growth is around 2-3%. So it's very difficult to argue that this inflation is because of easy monetary conditions, or that easy RBI is to blame for this this inflation, because it clearly shows that demand condition, credit condition, monetary condition still is not the primary driver for inflation. Our outlook for food inflation is quite benign. One, monsoon has been quite good. And the second is that we are having abundant grains in our buffer stock. The outlook for Kharif output for this year is again likely to make another new record high. And thirdly, more importantly, the hike which Government of India does, it has still been very muted, around 3.9%. If we look into the past, typically episodes of high food inflation has coincided with years when we had a big rise in MSP price or wheat price pulses. But this time, since the Modi government has come in, this hike has been quite muted. And this is one I would say one very important reason why food inflation has been very low since last few years. So our outlook on in terms of inflation is we broadly agree with RBI's outlook of 5.7%, maybe 0.2% here and there can happen. We broadly agree with the outlook. I think the key risk would be what happens on global commodity prices, what happens on the crude price. But assuming that as things stand, OPEC is committed to not let oil prices flare up too much. Our base case is that from this current 6.3%, we should see a gradual disinflation, which RBI is forecasting. And therefore, our sense is that the withdrawal of monetary easing is going to be a pretty gradual affair. The current estimate is that the first reverse repo hike can happen earliest by December. It can even happen later also, but earliest by December. The only thing which can change it are basically two things which we need to look into. One, if suppose we have big spike in commodity prices, big spike in crude price in particular, that's one risk. And the second is, if suppose what we discussed earlier, which a lot of market participants believe that US inflation is transitory. If it turns out to be not so transitory, if you see that US job growth, wage growth is happening fast, and if Fed turns quicker, then faster normalization in advanced economies is also going to spill over into all emerging market economies, and then RBI may be tempted to withdraw its extraordinary policy accommodation somewhat faster. But in both cases, our base case is that even in the worst case, unless there's always like 5% possibility, which can be very nasty. But generally, in majority, in most of our scenario that we can build, we see a very gradual uptick in RBI's rates from here onwards. I think it's going to be a very gradual thing. They have been giving this message in the last 6-8 months, and the numbers since then have borne out what we have been saying. Strategies like roll down strategies are so typically whenever RBI is withdrawing its policy, generally because market has anchored to what has happened in the previous cycle. Generally, there's a lot of volatility in the markets, and in such circumstances, strategies like roll down strategy are the best place to be in. In any case, roll down. You can choose the roll down strategy based on the investment horizon. But otherwise, also, those who are looking worried that RBI is now looking to hike rates and they should and let's keep money in cash. I'd again like to point out that given the steepness of the yield curve and given the fact that RBI has sounded so dovish, so this dovishness assumes 5.7% inflation this year. So a lot of negativity is already in the RBI's assumption. And given that background, I think it's in a reasonable, probabilistic framework. What we can foresee is that the rate hike path is going to be very gradual, and therefore it doesn't make that much sense to be in overnight rates. And I think depending on your investment horizon, 3 months, 6 months, 9 months, you should go up the yield curve to gain from the accrual gain that you can get over there.
Thank you for your time today and covering broadly in terms of your views and perspective on the policy updates and broader fixed income market outlook. I am sure all our partners and viewers or investors on this webinar would take a lot of insights out of this, and hope to keep connecting like this with our partners on similar platforms going ahead. Take care, be safe, and Bhupesh, once again, thanks for your time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.